Managing taxes as a content creator is difficult and confusing. Dang it. So today in this video, I want to share with you guys this document, which gives you everything that you need in order to make every tax season a breeze while avoiding IRS penalties and fees. But first, let's go make a coffee.
The first and maybe the most important part of your creator taxes are quarterly taxes. One of the most common and most disastrous situations that creators come to me with is big earnings and no tax savings and no idea that they were even supposed to be paying taxes every single quarter. This takes an already large tax bill and expands it as the IRS places penalties and interest on any unpaid tax. So here's the plan that you can use to avoid this headache altogether. You first need to understand that there are 4 tax payments that need to be paid throughout the year. The quarter 1 payment is due on April 15th of the current year. Quarter 2 is due June 15th. Quarter 3 is September 15th. And quarter 4 is due on January 15th of the following year. What I like to do is set reminders on my calendar a week before the due date and on the date that the taxes are actually due. Now, there are a couple more things that we need to touch on in regards to this quarterly tax system. First, how do we even calculate this quarterly tax? And 2, the simple system that I use with all of my clients so that we take advantage of this cash just sitting aside. Now, the actual calculation is just way too complicated, so we're not even going to get into that, but there's a couple of rules of thumb that we could use. Sidebar, but if you want to do the tax calculation, you can actually go to the link in the description because this creator tax pack is completely free. And even if you don't want to do the calculation, go grab that creator tax pack because there's a lot more information in there that we're not going to cover in this video. The first is saving 20 to 30% of all of your income. But with this option, you might oversave or you might very well undersave and have a large tax bill at the end of the year. In my opinion, a better option is to analyze the tax brackets, then estimate where you think your income would fall. Then use that top tax bracket that you fall into, minus 3 to 5% depending how deep into that bracket you are, and then use that number to set aside into a savings account. Now, like I said, in my opinion, the second rule of thumb is better than the first, but it could still lead to minor over or under payments. But again, estimating your quarterly taxes with a CPA or a financial planner may lead to that same result either way. Now that you know how much to save, let me walk you through the simple system that I use so that we can optimize these savings. The very first thing I do is open a high yield savings account and label that account tax savings. Then you would just calculate your federal tax obligation, which you can use either one of those methods that we had discussed before. Now, if you're calculating the entire federal tax obligation that you'll have for the full year, what you'll need to do is divide that number by 4, and that's going to be the quarterly payment that you need to make. Then you'll want to divide that by 3, and that's going to give you how much money you need to be saving every single month. Then you're just going to set up those reminders that we had discussed before, and please make your payments. Now, this is a bonus, but what you really should be doing is recalculating this quarterly tax estimate every single quarter based off of how much money you've been earning for the full year and how much you expect to continue to earn. Now, this is something that I'll just touch on pretty quickly, and that is tax diversification. There are 3 different types of accounts for tax purposes. There's taxable accounts, tax-deferred accounts, and tax-free accounts. Taxable accounts are going to consist of your investment accounts, which are like your brokerage accounts, and also things like high-yield savings accounts that you might have open as well. Tax-deferred accounts are things like your IRAs and 401ks with your employer. And then your tax-free accounts are Roth accounts and health savings accounts. Now, all of these accounts are going to have their different purposes. Maybe one of your goals is to retire early, and in that case, a taxable account can bridge the gap between your official retirement and the age at which you can withdraw from your retirement accounts. But taxable accounts could be good for other purposes as well, maybe for like shorter term goals like buying a house or saving up for a new car. Now, tax deferred accounts mean you don't pay tax today, but you will when you withdraw. These are your traditional retirement accounts, and they're best used in the low tax brackets during your retirement years. Now, as you near those higher tax brackets, this is where your tax-free accounts come into play. You could potentially be making $150,000 per year in retirement and take out up until that 12% bracket from your taxable or tax-deferred accounts. But then once you need to bridge the gap between what that amount is and the other $150,000, you can start withdrawing from the tax-free accounts like your Roth IRA and reimbursing yourself from your health savings account for previous medical bills. So ultimately, you could keep yourself in the 12% tax bracket while having an income well over that. Okay, so I hope this helped you understand why it's so important to have assets spread across these 3 different account types. Now it's time to talk about creator deductions. These are some of the most popular deductions that we see other creators taking advantage of. Equipment and tech include things like your SD cards, the camera that you use to film your content, maybe some lighting equipment, and a lot of other stuff as well. If you have a dedicated office space for conducting business and filming content, a portion of your rent may also be deductible as well. Software and subscriptions might include subscriptions to things like Adobe, Figma, Canva, or ManyChat. If you're speaking on panels or attending creator events to network with fellow creators, then travel expenses like hotels and flights can also be deducted on your tax return. Maybe you have a school community who charges you fees, or maybe your payment processor charges you fees as well anytime a payment gets processed. Well, these are typically deductible on your tax return too. Paying for another creator's course could also be a taxable expense. Now, one that I see missed quite often is self-employed health insurance. As creators, we are all technically considered self-employed, and as such, we have to purchase health plans for ourselves. And these premiums that you're paying for your health insurance are pretty brutal, especially if you live in California. But at least they're deductible on your return too. Now, with all these deductions and expenses, it can be extremely difficult to track everything, but here's a simple system that you could use in order to keep track of it year round. The first thing that you can do is create a rule in your email account that files emails containing the word receipt into a file that stores all of those receipts. Then at the end of the year, you'll have a folder with all of these receipts that you could easily go into and download so that you make sure you're taking every single expense and deduction that you qualify for. Now, if you have physical receipts, simply take a photo on your phone. And if you have an iPhone, these will automatically get sorted for you. Quick tip, if you have physical receipts, take notes on these receipts so that you remember what you purchased, why you purchased. And remember that this is especially useful for dinners with clients so you remember exactly who you went out to dinner with. Now, the next important consideration that creators need to take when it comes to planning for their taxes is retirement planning. There are a lot of different retirement plans that we can use as creators and business owners, but typically we're going to eliminate the simple IRA or group plans right off the bat because typically those are best for people who have employees, and many of these creator businesses that are being ran do not have any employees. This leaves us with the solo 401k, SEP IRA, traditional IRA, and Roth IRA. To keep this super simple, I have this best for section that tells you exactly who these plans are best suited for. So solo 401ks, SEP IRAs, traditional IRAs, and Roth IRAs are obviously going to be best for people with no employees like we had discussed before, but the solo 401k is going to be best for maximizing contributions and if you think that you might want to take out a loan from the account at some point. Now, the SEP IRA is pretty similar to the solo 401k, but typically you could contribute slightly less to it because you can only contribute 25% of your net self-employment income, but SEP IRAs are also super simple to implement. And then contributing to Roth IRAs are best for people who expect to be in super high tax brackets later on in life. Now, before we wrap this video up, I need to touch on one more section that has the potential to be the biggest tax savings opportunity out of anything that we've discussed today, and that is entity formation. There are 3 main entities that we see creators elect. The first is the sole proprietorship, which is great for when you're first getting started. The second is an LLC, which is great in limiting your liability and separating your business assets from your personal assets. The last is the S Corp, which is technically still an LLC, and it's just an election to be taxed as an S corporation. Now, the S corporation is that massive tax savings opportunity that we were talking about earlier. Now, this is how it works. As a sole prop or LLC, you pay 15.3% self-employment tax on net profit. Whereas with an S corporation, you only pay that 15.3% on the salary that you pay yourself through the business. For example, say we have a business doing $300,000 in revenue with $50,000 in expenses. The sole proprietor or LLC would pay 15.3% of that $250,000 profit as a self-employed tax, which equates to $38,250. Now, the S Corp has an extra expense, which is the creator's salary. In this situation, let's assume that the salary is $50,000. Well, now we only pay 15.3% on that $50,000 salary, which is $7,650. The remaining $200,000 flows through to the creator as an owner's distribution. In this situation, the creator would be saving roughly $30,000. Now, this strategy doesn't work for everybody because there's added expenses like payroll and bookkeeping, but we typically see it start to make sense when creators earn $60,000 in net profit. Now, these were some of the most important parts for content creators and other freelance business owners to understand when it comes to taxes. But there is so much more in this document, so if you want to grab your copy, go to the link in description and you could grab it for completely free. If any of this video was beneficial to you, please leave a like, comment, and subscribe. It means the world to us. Until next time, cheers.